Hello traders, welcome. Now that you are beginning to trade, we'd like to enlighten you on crucial forex trading routine that enhances a trader's success. We recommend that you take time to watch all the videos on the playlist to be fully equipped on forex trading foundational knowledge. In this video, we'll be looking at forex journaling, often referred to as keeping a trading diary, the significance of Forex journaling and the various steps involved in forex journaling. Stay tuned to learn this critical trading discipline. Journaling in forex is a crucial practice for both beginners and experienced forex traders. It involves the systemic documentation of your trends and the analysis of your trading decisions. The primary reason or purpose for journaling in forex is to enhance your trading performance by learning from your past experience. It is important to note that keeping a trading journal in forex is of paramount significance for numerous reasons, as we will see below. So, the first significance of keeping a trading journal is it enables you to do your self-reflection and to continue learning from your trends. A trading journal allows you to review your trading decisions in a systematic way. You can analyze your trends, both those that were successful and those that were not successful. As such, you'll be able to identify patterns and learn from the mistakes that you made. This self-reflection is crucial for continuous improvement as a forex trader. The next significance is it enhances objective assessment. Journaling helps you to maintain an objective record of your trading activities. This can be invaluable, especially when emotions can cloud your judgment during live trading. By referring to your journal, you can make rational decisions based on past experiences. The next importance is that it enables you to identify your strengths and weaknesses. Through a journal, you'll be able to pinpoint your strengths and weaknesses as a trader. You will be able to recognize which strategies work for you and which do not work for you, or those that work against you. This self-awareness allows you to focus on your strengths and work on improving your weaknesses. Another importance is that it enables you to work on your emotional control or to control your emotions. Trading can be emotionally challenging. Keeping a trading journal helps you to track your emotional reactions during trades. Over time, you can work on controlling your emotions and make more rational decisions, which is critical for long-term success. Again, journaling is important in that it enables you towards risk management improvement. You can assess the effectiveness of your risk management practices by reviewing your journal. It helps you to understand how well you are protecting your capital, which is fundamental in forex trading. The next importance is that it enables in strategy optimization. It enables in strategy optimization. With a trading journal, you can fine-tune your trading strategies. By analyzing your past trends, you can identify which strategies are the most profitable and adjust or eliminate those that consistently result in losses. Another thing, it enables accountability. A trading journal keeps you accountable for your trading decisions by reinforcing discipline, making it less likely that you will engage in impulsive or undisciplined trading. It plays a critical role in record keeping for taxes or tax purposes. A well-maintained trading journal can serve as a record for tax purposes. It allows you to document your trends and profits in an accurate manner, making tax reporting easier and less prone to errors. Finally, it enables you to work on long-term success. Ultimately, the consistent use of trading journal can contribute to long-term success in forex trading. It helps you to develop a structured approach, learn from your experiences, and refine your trading style over time. Let us now delve to how to set up a trading journal. So there are numerous steps that are involved when working out your trading diary on a day-to-day basis or on a trade-to-trade basis. And as you'll see, some of the critical elements that you have to incorporate are as listed on the columns that you can see on the chart. You have to factor the date, the currency pair you are trading, at what price you enter the trade at what you exit at, the lot size that you are trading, your stop levels and take profit levels, the strategy you utilized, and the reason or rationale behind taking your trade. So the first item is setting up your trading journal. Basically, you can use a physical book or digital platform to maintain your trading journal. Numerous traders prefer digital spreadsheets, while there are those that use journaling software to easily organize and analyze their trades. As we have seen, a typical trading journal should have columns for data as included on the chart. As you can see, such data as the date, the currency pair, entry price and exit price, trade size, and so forth and so on as listed on the chart. So the next step includes record the trade details. For every trade you make, note down the essential details including the currency pair, entry and exit prices, trade size, date, and the time of execution. Let us have an example. Say, for example, that you decide to enter a trade in the Euro USD currency pair. You record the date, the pair, Euro USD, the entry price, for example, early in the day at 1.0575, the exit price probably at 1.0595, the trade size, for example, one lot size, and the time of execution. The next step, you have to list the trade rationale, the reason behind or the reasons that will cause you or will make you to take the position in the direction that you'll be taking the position. Specify the trade strategy or system you are using. Describe, explain why you entered the trade. Document the technical and fundamental factors that influence your decision. For example, you say you entered the Euro USD trade because you identified a bullish trend on the daily charts, and there was a recent support bounds at 1.0570. This forms the basis of your trade rationale. The next step involves defining your trading strategy. In this case, we are going to describe the rules and criteria that lend to this trend. For example, if you are using a moving average crossover strategy, detail the specific parameters and conditions. Let's say, for example, if you are using a moving average crossover strategy, detail the specifics of your strategy. You mentioned that your strategy is to buy when the 50-period moving average crosses above the 200-period moving average on the 4-hour chart. So the next item or the next step includes documenting the risk management. Record your stop loss and take profit levels as well as the risk to reward ratio for each trade you take. This information is crucial for assessing the effectiveness of your risk management practices. For example, let's say you set a stop loss at 1.0555 to limit potential losses and a take profit of 1.0595. Remember, you entered at 1.0575, taking a long trade. In this case, your risk to reward ratio for this trend is 1 to 1. This means you are willing to risk 1% of your account balance to potentially gain 1%. So let's look at the next step. The next step involves analyzing the outcome of your trade. Analyzing the outcomes of your trade. After the trend is closed, review the results. Document whether the trade was profitable or resulted in a loss. Include any spillage or unexpected price movement that may have impacted the outcome. After the trend is closed, you calculate the trend's outcome. In this case, you made a profit of 20 pips. That is, from 1.0575 to 1.0595, which corresponds to $200, since each pip is worth $10 with your trade size. Remember, you are trading a lot size of or a standard lot. So the next step includes reflecting on emotions and psychology during the trade. Reflecting on emotions and psychology during the trade. Here, what you do, you note your emotional state during the trade. What was your condition? Were you anxious? Were you overconfident or desperate? Understanding the psychological aspect of your trading can help you identify and manage emotional bias. For example, during the trade, you experience moments of anxiety when the price briefly moved against your position. You realized that managing emotions during trades is a significant challenge for you. So the next step will identify the lessons you learned. Identify the lessons you learned. After a series of trends, look for patterns and trends in your trading behavior. Recognize what works and what doesn't work in your trading strategy. This self-awareness is crucial for improvement of your trading. Over several trends, you notice, for example, you notice that you tend to exit winning trends too early due to impatience. You also realize that you often set stop loss levels too close to your entry point, resulting in more losses than necessary. So the next step before we reach the final is regularly review your journal. As a trader, it is advisable to set aside some time to regularly review your trading journal, preferably after each trading session or at the end of the trading week. Analyze your performance and see where you can make improvements. After a series of trades in G, or for example, trades that are done on a weekly or a monthly basis, you review your journal and find that a pattern has emerged, that your losses are primarily due to emotional decisions and inadequate risk management. So with such a review, you should be able to find out how you are going to adjust, which brings us to our next and final step in journaling: make necessary adjustments. Here, you use the insights from your trading journal to fine-tune your trading strategy and risk management approach. Gradually or slowly, implement the changes based on your journal's observation. For example, based on your journal's observations, you decide to incorporate techniques to manage your emotions, such as using automatic stop-loss orders and setting more realistic profit targets. These adjustments are designed to improve your trading performance. So, as we come to the end of our video, it is worth noting that incorporating journaling into your Forex trading routine can be a powerful tool for self-improvement and discipline. It helps you to develop a systemic approach to trading, learn from your trading mistakes, and build on your successes. Over time, this practice will contribute to more consistent and profitable trading. May you find success as you practice journaling and exercise the discipline of journaling in Forex trading. Thank you. See you in the next video, which we will be uploading very soon.